with a relief rally in risk as three major central banks bring in some dovish rhetoric. Some believe the bottom is in the equity market. I, on the other hand, still believe this is simply a bear market relief rally. And I personally still do think there is more downside to come. Stay tuned in this video. What is going on, everyone? Happy Sunday. Before I start this video, do follow me on Twitter. This is my only handle. This is the handle I'm using on a daily basis. So for trade updates, market updates, do follow me on that channel. And just a brief announcement, I am releasing a 2022 playbook with all the lessons I've learned, both fundamental and technical. This will be available in December, and it's 100 copies only, from the macro themes to technical reversals, technical entries, new technical things that I've learned throughout 2022. 100 copies available in December. Stay tuned. Right, equities. Some believe the bottom is in. I personally believe that this rally that we have seen are simply for the three central banks that have provided some sort of dovish rhetoric and a slowdown in their tightening. That started with the RBA, went on to the Bank of Canada, followed by the European Central Bank this past week. Although the ECB met their targets of 75 basis points with their rates, they did provide some sort of dovish rhetoric around their future hikes. Now, the fear with this is, are these central banks slowing down amidst concerns that they have tightened too quick? We know Canada has led the central banks into their tightening cycle. Could this be the pivot? That's what this video is about, so stay tuned, carry on watching, and let's get straight into the video. Right, as we know, dollar index, we have to start on the dollar, see where the dollar is positioned, more so where it could go. This coming week on the 2nd of November, we have the Fed meeting, which in my opinion happens to be one of the most important Fed meetings this year. As I've just mentioned, we had three central banks provide some dovish rhetoric and a bit of a slowdown. What will that mean for the Fed? The Fed's current interest rate is at 3.25, and it's expected for them to go ahead and raise by 75 basis points. So looking at that, in my opinion, it's marginally not priced in yet. The only reason dollar is where it is, in my opinion, there again, is simply because of both interventions from the Bank of Japan and the MOF, along with the PBOC, the People's Bank in China, People's Bank of China. We know they intervened in their currencies, which naturally gave us outflows of dollar. So we had that sell-off into key areas of interest around the 110 handle. We did have that bounce on Friday. We had that bounce because if you take a look at dollar CNH, we reversed the intervention. As we know, this is the second time they've intervened in 2 months, as I have been reiterating. The fact that they have intervened in the past gives us some sort of forward guidance to see how the market reacts. Is the market going to fully tumble? Is the top on the dollar in? More than likely not. So these little corrections that we see should simply provide us with short-in opportunities on the dollar crosses because we still remain dollar bulls. So looking at dollar index, we know that we had this little bounce out of 110. Now, my favorite trade of last week was euro and cable out of the highs. Now, I took a short on the euro. That was on Thursday, simply because simply because I knew on Thursday we had the ECB. Now, the fact that we had that little follow through on the euro simply states that this move to the upside was irrational. This move to the upside was just pre-pricing in what the ECB were going to do. We know they came out with a bit of dovish rhetoric. Christine Lagarde reiterated that, going forward, they're going to be monitoring how the economy reacts. So more of a forward guidance play. However, abiding by the Federal Reserve's reaction function. It is simply a tool that allows you to wait, see how the economy has reacted before changing your policy or changing your stance. As we know, inflation's lagging. It's a rear view indicator. It shows us what has happened in the past. So all central banks tightening their policy right now. And funny story, I'll actually put a chart over here. We've had 240 interest rate hikes this whole year. That's crazy. That's about one interest rate hike per day from all global central banks, over 100 central banks. This then shows us that, fine, these central banks have been going for it. That is the reason why we've had global tightening. We've seen global growth slow down, global equity markets turn, risk assets such as Bitcoin, commodities, equities, all tumbling. So my only concern is, has the global economy tightened too hard, too quick, and they just want to pause? Pausing will negatively price into the currencies, in my opinion. However, is a pause simply stopping, looking left, looking right to see how the economy is actually reacted? Yes. If we, any one of us, yourself or myself, making this and you watching it right now, if we were in their shoes, we would do the same thing. The Federal Reserve have been on their most aggressive hiking path ever. Most central banks, they forward guide. The Fed, however, has something called a reaction function. They will raise interest rates, look around to see how it's affected. Because if you look at the jobs market, the labor market is the strongest it's ever been. Unemployment's at 3.5. The JOLTS job openings, which shows the amount of job vacancies, is the widest it's ever been. So there is demand. What does that cause? Wage inflation. If there is so many vacancies, people will pay more to fill those vacancies. If people earn more, they're going to spend more. Inflation is still a problem. So for myself, back to the dollar, not to go on too much of a rant, but looking at dollar, we know the Fed are far from their target. We know that it's all about their tone. So for myself, I still see them raising by 75 basis points, right? This coming meeting. And then that will obviously take their rates to 4%, but then it's up to us to then identify how the market will react. So for me, it's all about their forward guidance for December, right? Should they get rates to 5% and they pause, when is that going to be achieved? And what's their language? It's all about their language. It's not per se what they do now, but it's about what they say they're going to do in the future. So for me, looking at dollar, I remain a dollar bull anywhere above 110. So should the market this week give us a bit of a correction into this key highlighted area of mine, I favor some dollar buying. Why? I want to be in a euro short if we get 10040, so 40 pips above parity. If we see that again, I want to short it. I do like it on the lower time frames. It does line up with a bit of a fib from the high to the low. Why? We've had that key reversal already. We've broken two previous lows, which will be in my handbook. I'm going to write everything down for everyone. I've already started it, so 100 copies only. Stay tuned. But we've had a beautiful little technical reversal, and the highest probability is trading the correction of this back into 1003, so 30 pips above parity. That's something I favor on the euro. You got the Aussie, beautiful reversal out of the high. So I do favor the market coming back anywhere into this highlighted area of around 64.50. What does that do? That lines up with a fib. If you were to fib it from high to low, I think my trading view is frozen. There we go. So if you fib it from high to low, it lines up beautifully in a key area of interest along with our fib. You got the higher time frames, you got the fundamentals, you got everything. You got the RBA slightly hiking less than expected this past couple days, and then you also have the Fed coming up. So should the Fed hike by 75 and provide some sort of hawkish forward guidance, euro is going to tank, Aussie is going to tank, cable is going to tank. Now looking at cable is firm purely because of the political uncertainty being unwound. The fact that the political uncertainty has been relieved, you've seen a relief rally in the markets. Rishi Sunak announced this past week that he is more than likely going to hike taxes for the consumers. This is to generate over £50 billion. Now, we need to look at the previous Prime Minister was trying to cut taxes to keep people happy. But that is simply going to induce spending. If you induce spending, inflation is going to remain high. Whatever the central bank does, it's not really going to work. You got Rishi over here that's working with the Treasury and working with the central bank, the Bank of England, to tighten policy. If taxes are higher, people have less disposable income, they're going to spend less, inflation should naturally come down. But we need to think how that's going to affect growth. You've got mortgage rates through the roof. right? You got higher interest rates at banks. So people that have credit are going to pay more. If Rishi raises taxes, people are going to have even less disposable income. So we want to think about the businesses this is going to affect. The businesses that rely on that income are simply going to be in a predicament because they have less income coming in. What about the staff that they have to pay? What about their inflation, producer inflation, PPIs? Still high, right? So we're sitting with a very, very tricky scenario right now. So I get why pound is trading higher. I get it. But at the same time, I expect dollar bulls to kick in. So if I look at cable, I'm not sure where the top may be because we have had a very bullish rally into the close on Friday, in my opinion. But I do think 114.50 will get corrected. We're going to correct into that area. I do just think it's a key area of interest, or even lower. Even back into these wicks over here on the daily. So 113.50. So if we are pound buyers based on a hawkish Bank of England, which is on the 3rd of November, by the way. So the day after the Fed. So it's a crazy, crazy week coming up. And then you have non-farm payroll. So fireworks, absolute fireworks. Now, looking at cable, I think I wouldn't mind being a pound buyer, but I can't buy at the high. We were in a pound long position from around 112.80, 112.90, call it 113 to be safe. And should we have held that position, or should I have held that position? Possibly. It could have been a 300 pip move. However, I traded my risk reward. I got a 3-to-1 risk reward, 160 pips banked. Beautiful. The beauty about being a trader is you know that you can constantly add your exposure when needed. Now, with there being such volatile situations in front of us, it is important and it's paramount to remind yourself that you're in control of your risk, no one else. You're constantly in control of the risk that you expose. You need to forget about where you want something to go, and you got to trade where it actually is. So for myself, I know that volatility will be high. I know that I have a better probability trading euro, trading the Aussie, because both of those central banks have provided dovish rhetoric. So there's a negative element to those currencies. Whereas if you look at the pound, you know that, okay, shit, the Bank of England are working to tighten policy. Got Rishi Sunak raising taxes. Those are two positives. So you got to be careful with shorting pound. And a perfect example is looking at the trading day over here. On Friday, euro closed pretty much break even on the day. Aussie down 40 pips. Cable 50 pips up. So you can spot the difference over here. RBA, dovish rhetoric, negative for the Aussie. Strong dollar off of 110. Aussie trading lower. Despite a dollar bouncing off of 110, cable remained bullish on the day because of what Rishi Sunak is doing. So the relief rally and the optimism of a new leader working with the Treasury and the Bank of England has positively priced into the currency. In terms of equities, we had this massive relief rally. And I want to talk about this for a second because we need to just think about this. In the day of social media, everyone has access to the news. Everyone has access to headlines. Everyone has access to the same information at the same time. Fun fact, we have had the most net short positions in the equity markets than we've ever had before. Why? People watch the movie like The Big Short. People watch the movie like Margin Call and think the exact same thing is going to happen right now. Let me go short. If everyone is short at the same time, what are you going to have? You're going to have a short squeeze. There are too many people. There's too much money short. If you have covering of those short positions, and what that simply means is if there's a big whale that is short on the way down, that big whale takes profit. There's going to have to be upside liquidity. That's a short squeeze. So it's covering the short positions. And personally for me, looking at these equity rallies, I mean, the Dow 3% on Friday, Nasdaq 4.75, the S&P 3.5. Massive rallies. If you look at this on the weekly time frame, in my opinion, price is still swinging to the downside. Price technically still looks bearish. We still know the Fed have a lot more tightening to do. We understand that global companies, you've seen the likes of Facebook, Google, Alphabet, right? You've seen Tesla slow down. Apple, right? Apple's a bit of a hit and miss. Some of their earnings releases were positive. Then you had some allegation about their iPhone 14 sales, which still a bit confusing. So I haven't done my research on Apple. Go ahead and do your own due diligence on that behalf. However, looking at global tightening, we've seen over 240 interest rate hikes this year alone. Global equity markets, in my opinion, should not be where they are. So for me, that's the lagging component. If this is simply just some short covering of net short positions, because the whole market thinks we're in a recession, short equities, everyone, myself included, right? So we need to think if this is just short covering, because net positions were short, you're going to have this upside rally very, very easily. Very, very easily. So for me, it's all about determining, does price react negatively around the 33,000 handle on the Dow, right? Is there some sort of slowdown? And I'd like to just briefly pause on the weekly time frame and just show you something. Every time a top is in, we have some sort of doji, some sort of pivot, some sort of slowdown, which, by the way, will be covered in my playbook, so stay tuned for that one. December launch date. Every reversal has a slowdown. Price is uber bullish over here. This is not a short position just yet. Not yet. We have to wait for the slowdown. We need to think how many people are trying to short this on the way up and how much liquidity is being trapped at. If this is a short squeeze, we could go higher irrationally until that coverage is done. Until that short coverage is done, we have to wait it out. But I do think anywhere along the lines of this region over here, so anywhere between 33,000 and 33,500. I called the short from 34. If you go watch my big short video, I'll try and pin it over here. Great short position over there. Price melted. Let's measure that. I didn't hold a position all the way down, but we melted 15% to the downside on the Dow. You got S&P 500, same thing. Bit of a short covering relief rally. NASDAQ, same thing, right? NASDAQ's obviously trading a lot lower than most of the other indices, but looking at the S&P, looking at the Dow, I do think there is opportunity here. So wait for that slowdown, wait for that reversal. If you don't know what the reversal looks like, get my handbook. It's coming out in December. So looking at the Dow, I do just think for myself, it is a case of I could be sure on this post FOMC want to have a bit of direction on Tuesday once the Fed announce their guidance. If they do raise by 75, it's all about their language. Please remember that. So same thing with equities. We obviously saw a relief rally in the crypto market. Bitcoin trading back above 20,000 now. I'd like to show you all something. In 2018, when we had this crash to the downside, price was held up by 6K as a level of support for months, right? For months before we snapped 50% lower. I personally think the same sort of price action is playing out where we are now, right? We were trapped in this little flag, which I think, if you look at this price action, lower high, lower high, lower high, I think lower high, lower high, lower high, you get the point, right? So I think we are squeezing ourselves into like a bit of a flag before one last capitulation lower. So my ideal target is more than likely around 11,500. Just these previous highs over here. I'm happy with that area. I'm happy to start averaging in at that price. So top end, let's go with 12,750. Bottom end, 10,900. If it spikes lower, you're averaging in, it's okay. Let's talk about what everyone is on about. Dogecoin. Right, Elon Musk successfully has purchased Twitter. Dogecoin's rallied over 100% in the past 5 trading days. Mad. So we know Elon, also known as the Doge father, right? He has his acquisition for Twitter was, positive for Dogecoin. So Dogecoin rallied 129%. Would I recommend buying now? No, don't do that. Right? If you are a long-term holder, then fair play. However, if you are looking to possibly capitalize on this for the next bull run, wait for a correction back to 8 cents, 7 cents. I know it is a meme coin. There is no real reason why you should buy this, but if it's worth a punt for you, then then it's worth it, right? So that's pretty much where I'm at for the whole market. Yen pairs briefly on the rally higher, as we did have some further confirmation from the Bank of England that, I don't know what's happening in my trading view, that they were going to be repurchasing or continuing to purchase JGBs, Japanese government bonds. This is a form of easing. So we had that weakness from the yen towards Thursday, Friday, and then that assisted that rally in dollar yen. But that is pretty much it from me, everyone. I hope you enjoyed this video. If you have watched till now, I appreciate you staying on. Do stay tuned for that playbook. It is going to be limited to 100 copies only. So do stay tuned. I'm going to be putting everything out there, everything I've learned, both technical and fundamental. And that can be your playbook going into 2023 on what you should be doing and looking out for. So stay tuned for that one. Do follow me on Twitter again. And yeah, like, comment, share, subscribe to this channel. And I'll see you all in the next video. Take care. Bye-bye.